So here's the thing. We got headwinds, we got tailwinds. Are you in the wake or are you ahead of the wake? Today on the Logistics Life. Well, here we are back for the second data day of the week. Yes, Dean, the data day, I only got time to post it on Monday. I know it's absolutely asinine, but hey, we get 2 data days in 1 week now for our audience. And I think today's call, just in kind of our quick chat before we hit go on this, I'm very interested to hear. So if you can, for the audience, just start right back at the beginning when we were talking about diesel, headwinds, tailwinds, and what's happening, and then we'll kind of take it from there. Because I already just in the 3 minutes we talked before, I got probably 6 questions to ask you. So I'll hold off as best I can, and I'll let you go.
So we were talking about it before we got on air, right? There's a lot of things that are happening that we don't expect, that don't normally happen. So whenever you have instability in the Middle East, especially what's going on between Iran and Israel, the Houthi rebels in the Red Sea, just Russia in general, you get instability, and it generally sends crude oil prices in the other direction. So you normally see crude oil prices skyrocket, and they haven't then. They just dropped 8 cents a gallon this week. That's the national average as put out by the EIA. That's the diesel price that's used in most fuel surcharge calculations, down to $3.55 a gallon. I filled up my truck last Saturday. This time a year ago in New Hampshire, it was $4.25. So remember, last September there was a real spike in diesel prices. Since then, it's dropped $1.08 or 23 cents, 23%. But then, since the June 2022 record high of $5.80 a gallon, diesel prices have dropped 40%, 40. So just in the last year, that
all this instability.
So in the last year, they've dropped 90 cents a gallon or 20%. So remember, if for every 10 cents a gallon diesel drops, it reduces an owner-operator's operating costs by a penny per mile. So operating costs have dropped about 10 cents a mile in the last year. It's staggering. So what it means is that owner-operators have had some real tailwinds, even though rates have been bottoming out and low-ish. They've been able to weather this storm, and I think whenever diesel drops like this, they get some real tailwinds, especially as we head into peak season, because we're starting to see some volume come back into the market. Now, I think this is an important point, because owner-operators, small fleet carrier costs have been, breaking even around $1.78 a mile, for the last 4 or 5 months. Nothing fantastic. So carriers are still at break even. Now, for context, that's I'm still paying myself $64,000 a year wage, but my operating costs, I'm only breaking even when I look at revenue minus costs. So I'm not making enough profit.
I'm sorry to interrupt you, but just for the audience, can you share some data on, in our market, like what percentage on average is small fleet owner operators? Because I know it's very high. So when sorry, go.
About 10% of the trucks on the road.
Oh, it's only 10%. I thought it was higher than that when it comes to small fleets and owner operators.
Small fleets and owner operators are much higher. They're upwards of 90%.
That's what I thought. Okay, that was
owner operators. Owner operators.
So small fleets and owner operators are the ones really benefiting in getting into this tailwind, which is 90% of the market.
And I say that because if diesel has dropped 40% since June, the summer of 2022, and you're still in the business, right, where rates are, there's a good chance you're going to survive this next period of time, right before the market really starts to pick up. So I think what we're left with, who's left standing, and it's the same for the broking market, same for the asset-based carriers. Who's left standing, I think, is going to be in really good shape for next year. We're not making, carriers are not making enormous amounts of money, but they're getting by, and they've been getting by for a good period of time. But I think the bigger carriers, though, are having a much harder time, because the bigger carriers have higher operating costs because they've got more overhead. They've got more, more long-term staffing costs they've got to factor in. They've just got a much longer set of fixed costs they've got to factor in over years. Whereas the smaller carrier is much more nimble, and their operating costs are lower.
So, okay. So now I have a question, because I'm sure a lot of people are asking this. Like, the larger carriers, obviously, when they buy fuel, they buy bulk, they buy cheaper than smaller carriers and owner operators, right? We all know that.
Yep.
So even with that, even with, cheaper tires, cheaper maintenance, because obviously the buying power and stuff, they're still at a disadvantage with the overhead, correct?
Because they can't do the miles the smaller fleets do. Right.
Got
So
it.
when you look at it on a cents per, they might be able to buy tires for $50 better than an owner operator that's in a buying consortium. Don't forget, most of these small fleets are running fuel cards, and they're part of networks where they get a really heavy discount off the price of diesel.
That's true.
So if you're with DAT's partner OTR Solutions on the factoring side, it's like about 41 cents a gallon cheaper. So I think if you're a savvy owner operator, you're buying pretty well, which you would have to be doing these days because cost control has been absolutely critical. Where the big carriers lose out on a pure cents per mile basis is if you're speed limited at 63 and 65 on cruise, for example, you're looking at an average miles per day of about 400, roughly, right? Owner operators who are not speed limited are running 600. Like independent contractors, owner operators, they're running a lot quicker. They're not breaking the law because the speed limit allows it in most states, right? You can run 75 in like 13 states or something like that. So, I don't want to get into a whole speed debate, but owner operators of small fleets are much more nimble. They're much more productive. They're much quicker in the market than big fleets that are speed limited. So that's why they're more efficient, and that's also why you've now been having for a couple of years now this debate about speed limiters for all trucks. Well, owner operators of small fleets aren't advocating for it. Right? It's only the big fleets who are, the smaller fleets are eating their lunch when it comes to, being efficient in the market. So that's a pretty big deal. So what it means is when you look at these earnings calls that are coming out, because we're in earnings call season for Q3, JB Hunt came out. They had, I think the headline with JB Hunt was, I think it was wasn't a miss. Was it a miss? They said, oh yeah, it was a big earnings miss. Todd Maiden reported. Lower revenue for a variety of cost headwinds plagued the quarter. Management called out weaker than expected demand and higher wages, equipment costs, insurance premiums as the culprits. Right? Martin, which is a big carrier that's got Martin's total fleet's about 3,000 tractors. Their fleet size is down 10%, but their operating ratio in truckload down 100.2%. So their operating ratio deteriorated by 300 basis points, or 3%, from 97 to 100.2. Miles dropped to about 1,600 per 1,600 per, what's that, per week average? Yeah, I'll have to do the math on that. But their mileage was down, revenue was down, average length of haul was about 533. So I think it's about 2,000 miles a week these trucks are doing. So that's not a good news story for large truckload carriers that are coming out of Q3. So what it's telling me is that this last year has been particularly tough. And I think JB Hunt's characterization of what the culprits were, weaker demand, yep, but higher wages, higher equipment costs, which is the cost inflation we've all been dealing with for everything, and insurance premiums. I think insurance premiums are going to be another story that's going to be told by a lot of carriers, because it's not just costing more for owner operators to buy insurance, especially new entrants, but the insurance industry generally doesn't do well in the trucking industry. It's always been a high operating loss ratio category, and the capacity has leaving the market. So as claims experience worsen, it burns the underwriters and the carriers, the backers of the capital, and they leave the market. So we're in what we call a hard market, or a hardening market, where capacity leaves and premiums go up. On top of that, claims experience has been worsening. So claims costs have been escalating. They're getting higher, but they're also taking longer. So they call it adverse claims experience, or adverse development. So there's that's sort of going on in the background, and that's some really big headwinds for large fleets. Smaller carriers with good claims experience, I think that's where they're going to see some real tailwinds this quarter because we're heading into a period where volumes are starting to increase. If you just get if diesel's down 10 cents a gallon, I've had carriers tell me this week they're paying just over $3 a gallon for diesel with their fuel buying programs. Like $3 a gallon, Dan. It was like almost $6 a gallon in the summer of 2022.
Mm-hmm.
So if you have diesel prices dropping and against what we'd all expect, given the instability in the market, and volumes are going up and rates are starting to climb, that's some real tailwinds for small carriers. I guess what I'm getting to is they don't have to leave this market because they're getting by and they're doing okay in general. Because I think we've seen the exodus of carriers, it's in the rear vision mirror. Now, that said, there were still some bankruptcies this week. Larger fleets, I still think, are struggling. There's a number of fleets I know that are trying to downsize rapidly, sell off equipment, sell off surplus equipment. There was a big fleet this week. I think Freightways reported it was Merck's. They've downsized their fleet substantially. They had a few hundred trucks in Chicago. So I think there's some rationalization still going on the larger fleet side. There'll be some consolidation, mergers and acquisitions still even in the broker side. So we're still in the tailwind of this. Q3 earnings calls are going to be pivotal because it'll tell you how hard carriers have been trying to deal with this freight market, whereas smaller carriers have been getting by for quite a while now. And I think and again, this goes back to what you and I talked about a few weeks ago, latent capacity. They made so much during the pandemic. They have a much lower cost base this time around. So I think we're in a market now where there's a lot of capacity in the small end of the market that's going to be diving in and out of the market because they can afford to. And that's going to keep rates fairly flat. So I think anybody here that's looking for talking to shippers about rates or buying capacity with carriers, I don't see a lot of upward rate movement next year. Our forecasts don't really show that rates are going to improve a whole lot. Certainly not double digits. Right, so you're looking at single-digit rate increases next year, Dan, more in line with inflation. I don't think you're going to see the sorts of gains we've all been used to.
But I mean, when we look at the gains we've been used to, so I got a couple of questions. So let me go back a bit because I want to make sure everybody listening understands when you were talking about operating ratios. So for all of you listening, and Dean, correct me if I'm wrong, when Dean said 102% operating ratio, meaning they're operating at 2% above their overall cost. Typical carriers are like 3 to 6% operating ratio, 6% being very good for a carrier, meaning 96% of every dollar they make goes to operating, 4% is profit.
Yeah, 97. Sorry. Yeah, you got it right. 97 is probably, if you have to say where's the industry long term, 95 to 97% is pretty good. Heartland was always in the high 80s forever. But when you start, 102%, 100.2% means that's a losing proposition. You can't sustain that longer. Yeah.
Yeah, and then like every load they move, every mile they move costs them money. And so now we get to the second question. So we're looking at the market, we're looking at what's happening, we're looking at larger carriers trying to get rid of equipment.
Yep.
Is that really feasible in the market? Like, so they're pushing equipment to the used market, but yet there's fewer carriers coming in. So there's going to be this, like, obviously the teeter-totter effect, supply versus demand that puts a lot of supply in the market. I would think at one point it would be, it would be kind of like, to give everybody a clear understanding of like Tesla, right? When Tesla first started to scale, they were itching to get the used cars back because there was a ton of people that didn't want to pay premium, and now they're like, well, we don't really want the used cars, like, because sales are down. So now they have used plus brand new to sell. So is that similar in the trucking market for all our listeners?
Yeah, it floods the market with excess capacity. So what fleets are doing at this point in time is, they kind of jettison aged equipment, surplus equipment, and that floods the market with, higher mileage vehicles that might not be as attractive to some carriers. It provides a lot more opportunity for smaller carriers to come in because the prices are dropping. Pricing right now for 6-year-old sleeper trucks was 7% lower month over month. It's about 1% lower than the last strong period of truck sales in 2018. So we're seeing fairly low prices. There was a really low number of trucks went to surprisingly low number of trucks that went to auction last month. September is normally a very high month for auctions. It dropped right away. So again, it's another data point that tells me used truck prices are dropping, and the number of trucks going to auction is falling, which supports our theory that the exodus of carriers because of financial difficulties is we're on the back end of that. Because
Okay.
when you look at the difference between carriers entering and joining on the DOT carrier authority side, it's back to break even. But we're not
Okay.
there's not a net loss in it. So I
So
think
then my next question to that then comes, and I'm sorry to hit you with all these questions, but I think it's such an interesting topic because it brings up a lot of these. Is 90% of the market is small fleets and owner operators.
right.
For those those out there thinking, oh, we've like the exodus is done, it means that that balance is going to come back to the market. But if it's now more affordable for somebody to get into the owner operator and small fleet space,
Right.
is it possible, if all this moves in line, that the whole capacity issue is not going to be resolved, meaning there's still going to be excess capacity because now we're making, sorry, not we, but now the market's easier for smaller companies to get in and owner operators to build.
Absolutely.
Okay,
Yeah.
so that is something on your horizon that you guys are keeping an eye out, right? Okay.
Yeah. I think this is the new normal. I think you've now got, because of the extraordinary profits during the pandemic, the fact people are getting by and we're able to withstand diesel prices that were much higher in the last couple of years. If you're still operating in this market and you're getting by and rates are starting to improve, I think you're in really good shape. And I think we're at the bottom of this cycle. We've been talking about that for a while, but we're almost 3 months into the next new cycle. And that means that we're seeing year over year change in spot rates positive for 3 months. They've been in free fall for 27 months. So we're heading into the next freight cycle, and I think that's sort of where I see the market. But and I'll go back to what I just said a minute ago. We see very low single digit rate increases next year, largely because the capacity that's in the market is going to keep a lid on whatever growth in demand there is. Because if you've got a truck and you can run for $1.50 a mile because you paid off all of your finance costs, and rates are sitting about $2 a mile right now.
That's
Even
a
if
huge margin.
even if they drop to $1.60 in January, like, you can still get by. Now, a lot of carriers listening would say, well, that's rubbish. Rates should be a lot higher. Yes, they should be. But that's not the reality of the freight market we're
Yeah,
in.
what they should be and what the reality of the market is and it's like that in every market.
Yeah.
It's two completely different things.
Yeah. So if you look at the average, right, and of course, no one's home at the average and no one's operating a truck for $1.79 a mile, because the operating costs vary depending on your equipment and when you run and how heavy, and it's flatbed versus reefer, all that stuff. I get that. What I'm trying to do is sort of paint a picture of directionally where the market's going.
Yeah.
Now, we're at the break-even level. We're about where we were when you take into account diesel costs and rates. We're about the same level of profitability as 2019 in September, October,
Okay.
which wasn't a great year.
No.
I remember it wasn't. But demand, when you look at Jason Miller's index that just came out, Jason Miller's TTMI, I'll just quickly look at it. It's flat. Jason Miller's TTMI still in a trough, down slightly year over year, but almost identical to where it was in 2018. So
yeah, and I think the difference between 2018, 19, and then now is I think there was a big learning curve in 2019, right? I think
sure.
With the mix of, and correct me if I'm wrong, I'd love your thoughts on it, but with the mix of 2018, the spend rate, probably what carriers were doing and how, so let me rephrase this. Based on the people I spoke to, and I remember I met you right around that time frame, and the conversation was at the TCA event that I met you at. I think everybody was talking about, we thought it was going to be this 5-year high because it typically goes like in years, right? And it ended up being like 10 months high. And so so many people purchased equipment. They grew their fleet thinking it was going to be this. And then as soon as the market dropped, then it kind of like fell right off a cliff. I think faster than the pandemic drop. It'd be interesting to see that graph, but if my memory serves me correctly, which isn't always great these days, but if it's like it was a huge drop, and I think all of a sudden companies had all this expense and rates just fell through the roof. I mean, I remember bids that were awarded were just people were just scratching them off and saying, "Nope, sue me if you want. I'm going to the spot market. Forget about it." And so I think there was like this investment period that never really paid off. Would you agree when it came to that?
Yeah, people, trucking industry, when rates are doing well and they make money, they buy equipment, and they bought them in record numbers exactly this time in 2018, because the market did start to soften in 2019, and that caught a lot of people short. So they were led. So I think this is really interesting. The other data point that's worth thinking about, Dan, I'm at our DATCON conference here with all of our users. We had a shipper day yesterday, the shipper summit, where all of our big shippers come in, all the national shippers that provide a lot of truckload volume. When I look at the average of all of the rates that are coming, because we're in bid season, right? So the last quarter of the year is bid season. Everyone's putting out their bids. It takes about 3 months to get all your rates into routing guides. They replacement rates. So these are replacement rates coming into routing guides for the very first time. So it's a brand new rate on a lane on the first load. So it's replaced the rate that was negotiated the year before.
Yes.
Now, this is a really interesting data point. They're coming in dry van 0.2% lower, refrigerated 0.9% lower, and intermodal 0.6% lower. So they're all low single digit, but less than 1% lower than the rates they're replacing. Right? So what does that tell you? It tells me that contract carriers, 80% of the freight being moved, are getting very close to the bottom of the contract rate cycle. Because for context, they've been dropping their rates for 18 months. Like, carriers have been trying to keep volume and drop their rate per mile for contract freight for the best all of last year and all of this year so far. Remember we
So how much did they drop? And it's probably a null and void question, but I'm going to ask it anyways, because obviously during the pandemic rates were astronomically through the roof. But say towards 2022 to now, what would be the overall drop in your estimate in rates?
I looked at it. It was about in spot rates about 30%. Probably
about 30% in 24 months.
Yeah, and about, I think it was about 20% in, I had 33% down in spot and a bit less in contract. So Dan, that's a good question, because remember we talked about, for context, rates went up 12 to 15% every month during the pandemic. They dropped 12 to 15% coming down, so carriers were dropping their rates at a fairly high clip. Start of this year, you and I talked about low single digits. They're in the 7-9% down range. They've got to the bottom where they're like 0.2% in the negative. So we're almost at parity, where new rates for recent RFPs are coming in the same as the rates they were negotiated at last year. So what that tells you is that capacity for large carriers and demand are getting very close to that equilibrium point. And from that point on, you would say, rates are going to start to climb. Remember, contract rates follow on a 4 to 6 month lag. Spot rates are already starting to move up, and contract rates are going to follow that cycle. So if you're thinking about bids for next year and where capacity is going to be, carriers, shippers here are thinking, rates are going to go up somewhere in the 4 to 5% range by this time next year. So that's what they're looking at.
So Dean, I've got a question. And I don't know, maybe it'd be something to bring on somebody from a larger carrier, maybe in the coming weeks, to talk about this. But so my question is, if we're talking like less than 1%, 0.02% lower and all this kind of stuff, is it the market balancing because we still have an excess of capacity, or is it carriers saying, okay, here's the deal, like I just can't go any lower than this. I need to stay in business. I want to be around next year. If I go lower, Mr. or Mrs. Big Shipper,
Yeah.
Like, I just can't do it. And then shippers looking at it and realistically saying, okay, so with everything happening in the market, the double brokering, the defising of FMCSA documents and all this kind of stuff, are we better to stay with the people that have been doing it and be loyal to them, even though they might not be as low as, say, hypothetically, the smaller fleet that's coming in, that we know these people, they know our business, that the company knows how we operate, they know what we need, that learning curve, if you will, or that change curve, I guess would be a better way of phrasing it, is not really worth the savings. Because one of the questions I'm having with a lot of people these days is, okay, I understand operating costs is big. Like everybody knows that it's big. But the question I ask is, like, what is the percentage that would entice you to try somebody new or make a switch? And I'm getting a lot of feedback from prospects, and they're saying, probably 5%. And I look at it and I say, okay, if it's a 5% switch on average, I'm averaging it out. Some are higher, some are lower. That's actually a 10% switch if I want to keep the business long term. Because you and I both know a carrier, broker, whoever it is, it doesn't really matter, loses the business. They're going to go back and say, where do I need to be in order to make it work? They're going to say 5%. Now the shipper just got a 10% decrease. Okay. And again, to all shippers out there watching, this isn't a, who can screw who. This is just real talk. But I'm wondering and would love your thoughts on, like, is it to a point where people are just saying, okay, enough's enough, right? Like we're into this new normal, I guess. I hate using that word, but I guess it's accurate. And because of that, like, here's where the reality is, wages are increasing, by this time next year, my cost is probably going to go up 4%. So I need to go up 5% in order to continue to make a living. Because again, for everybody watching and listening, if your operating ratio is 3%, right? Like, so meaning your profit is 3%, operating ratio is 97%, and costs of living go up. The owners and everyone in the company would like to have their wages go up for that cost of living, right? Because I think that's just normal. So if your operating ratio is still 3%, or your operating profit still 3%, you kind of want to put that to 4 to give everyone the opportunity to grow. Am I right with that thinking?
Absolutely. Absolutely. So Dan, listen to these shippers talk yesterday. They're all aware that cost of freight is going to go up. And that's what they're trying to manage, is the upside. So they're actually being very clever about it. So remember, 80% of their volume moves on 20% of the lanes. And we had someone say yesterday that they use a lot of dynamic pricing, API pricing. So they'll have a broker, a group of brokers in their non-asset group, and they have API connections. The brokers are all paired in, have API connections into the TMS system. So it's really interesting. The brokers now shippers now have tools where they can carve out low volume lanes. One of the shippers said yesterday, a low volume lane is a couple of loads a month, right? And what they'll do is that it's sort of not in the routing guide where there was an RFP on that lane. They just send it to the market using dynamic pricing APIs. And what they have are these things called API carriers. So API carriers, Dan, are not people that would have been part of an RFP. But API carriers are ones that a shipper has a low volume lane or an overflow of volume or a surge in volume. They just send it to the API carriers who, bid on it in a nanosecond. Like a lot of it's, about 70% of it's automated in terms of the response to the API load. So that to me was very different. That the shippers are now behaving in a way like brokers do, because they've got the tools to be transactional. Really interesting, Dan. I'd not thought about that before. So what you're seeing is shippers being very strategic. They are aware that they have tools now to reality check where rates should be in the markets through the API side of the business. But the bigger picture, when you pull back, they're aware that the market is at the bottom and the rates are going to go up. When they're bidding for loads, they're putting bids out now. They are fully expecting that by this time next year, rates will have to be higher, because the carrier's message is exactly like you said, we can't operate at the costs we're at, which goes back to the start of our call. Martin Transport just reported that their ORs are over 100. So they can't sustain where they're at from a revenue per mile perspective, because they operating costs, you can't claw back driver wage increases that were record levels during the pandemic. You could stop paying private sign-on bonuses. We're all paying more for insurance and fuel filters and tires. But there's the cost inflation that we've all had to absorb. And that's what we're seeing, the tail end of that high inflationary effect on what it costs to operate equipment. And that's coming out through the earnings calls. So I think that's where large carriers are at. They're saying, hey, we're at the bottom. We can't sustain this. And whenever you see fleets start to go bankrupt, like we've seen this week, that's the tell. That's the tell that we're at the bottom.